All right, welcome to the Explainer. Today, we are cracking the code on accounting, which is really the system that tells the financial story of every single company on the planet. So, let's kick things off with a really basic question that everyone, from the owner to an investor to an employee, wants to know. Is this business actually succeeding? I mean, how can you even tell? Well, every single business out there has a story to tell. It's a story of wins and struggles, of profits and losses. But here's the twist. This story isn't written with words. Nope, it's written in numbers. And that system is what we call accounting. At its heart, it's really just an information system that does three main things. It measures what a business is doing, it processes all that data into easy-to-read reports, and then it communicates the bottom line to the people who need to make the big decisions. Okay, so what's really interesting here is that this financial story, it's not a one-size-fits-all kind of thing. It's actually told in two completely different ways for two totally different groups of people. You've got financial accounting, which is for the outsiders, think investors, banks, the government. And then you have managerial accounting, which is the inside scoop for the managers who are making those day-to-day calls on budgets and new projects. All right, just like any language, the language of business has grammar. It has rules you gotta follow. And the whole thing is built on one simple, super elegant, and incredibly powerful equation. And here it is, the big one. Assets equals liabilities plus equity. This right here, it's the absolute bedrock of all accounting. And the number one rule, the golden rule, is that both sides of this thing have to be equal. Always. No ifs, ands, or buts.
Okay, let's tear this apart. First up, on the left side, we have assets. Super simple. This is all the valuable stuff the business owns that's going to help it in the future. We're talking cash in the bank, the land the office is on, even the box of pens in the supply closet.
Now let's hop over to the other side of the equation. We've got liabilities. If assets are what a company owns, liabilities are what it owes. These are basically the claims that outsiders, like the bank that gave them a loan or the supplier they haven't paid yet, have on all those assets. And that brings us to the final piece of the puzzle, equity. So if liabilities are the claims from outsiders, equity is the claim from the insiders, the owners themselves. Here's a simple way to think about it. If the company sold off everything it owned and paid back everyone it owed, whatever cash is left over, that's the equity. That's what the owner gets to keep. All right, so theory is one thing, right? But the best way to really get this is to see it in action. So let's follow a brand new business, we'll call it Smart Touch Learning, and watch its financial story get written one transaction at a time. And so it begins. The owner, Sheena Bright, kicks things off by investing 30 grand of her own money. Now watch what happens to our equation. The business now has an asset. That's the $30,000 in cash. And at the exact same time, Sheena's personal stake, her equity, is also $30,000. See that? Perfectly balanced. Okay, next up, the business needs some office supplies. It gets $500 worth, but, and this is key, it buys them on credit. That just means they'll pay for it later. So what happens? The company's assets go up because it now has $500 in supplies. But it also has a new DIT, so its liabilities also go up by $500. And look at that, still balanced. All right, now for the fun stuff, making some money. The company does some work for a client and gets paid $5,500 in cash. This is great news. Its cash, an asset, goes way up. And that new revenue, it also increases the owner's total claim, her equity in the business. But you know what they say, you gotta spend money to make money. So the company pays for rents and salaries, which comes out to $3,200. That means its cash, an asset, goes down. And those expenses also chip away at the owner's claim, so equity goes down too. And through it all, still in perfect balance. So we've had all this activity, money in, money out. How do we take a step back from all these individual transactions and just get a clear picture? How do we turn this big list of pluses and minuses into something simple, like a report card for the business? Well, we do that with 4 key reports, which are called financial statements. You can think of them as the different chapters in the company's story. First, you have the income statement. This answers the big question, did we actually make a profit? It just lists revenues minus expenses. Then there's the statement of owner's equity, which tracks how the owner's personal slice of the pie has changed. The balance sheet. This one is a snapshot, like a photo taken at one specific moment in time. It shows exactly what the company owns, what it owes, and it lays out our big equation. Assets equals liabilities plus equity. And finally, the statement of cash flows does exactly what it sounds like. It shows where every dollar came from and where every dollar went. Put them all together and you get a really complete picture of the company's financial health. Okay, let's get to the final chapter here. How does all these numbers and reports connect back to making smarter decisions in the real world? Because, that's the whole point, right? Well, one of the most common and frankly most powerful ways to see how a company is doing is to calculate something called return on assets, or ROA for short. It's a simple little formula that tells you straight up how good a company is at using its stuff to make money. So let's take this out for a spin with a real-world example, a huge one. If we take this exact formula and plug in the numbers from PepsiCo's public financial reports back in 2021, we can see they generated a return on assets of 8.2%. And this is where the magic of accounting really shines. That 8.2%, it's not just some random number. It tells a story, a really clear, simple story. What it means is that for every single dollar's worth of stuff PepsiCo owned, we're talking everything from its giant factories to its delivery trucks, it managed to generate 8.2 cents in pure profit. So here's the big takeaway from all this. Accounting, it's not just some boring, dusty thing that only accountants care about. It is the universal language of business. It tells the story of how a company is performing, how efficient it is, and what it's really worth. And this language doesn't just apply to giant corporations. It applies to your own personal finances too. Your money is telling a story right now. The only question is, are you listening?